So we had 6 quarters of pretty poor earnings, and I think you have to sort of say, well, why? And I think it's, in our view, it's something along the lines of the government here in India putting the house in order. So we saw a significant reduction in the fiscal deficit. So we're now looking for the current fiscal year, probably around 3.5% of GDP. We've had a material reduction in the trade deficit as well. That's unlocked better inflation performance. And so now we have this virtuous cycle where interest rates can come down, but the government, having particularly reduced, current government consumption spending, can begin to ramp infrastructure spending. And at the same time, we now see civil service salaries that have been under control somewhat expanding again. And indeed, if you look at the Naukri job portal, which looks at job openings, that's also improving. And then, of course, we're hopeful for the monsoon season. The tracking there looks quite good at the moment. So all of these things suggest to us that after a period of really quite tight fiscal positioning, which did affect corporate earnings, both the government side of things and the private sector side of things can be swinging up from here.
I'd like to draw your attention to what's going on in the world. And if I look at the broad classification for Nifty 50, the big benchmark, broadly 40 to 45% of the earnings for the Nifty 50 are global in nature. And that's the trouble. Exports are low. Sectors like pharma and IT, they are slowing down. So the economy-related sectors may be picking up, but the export-related sectors are slowing down.
Yeah, that's a very common problem globally. Global trade has been very weak for some considerable time, and the countries that are most exposed to global trade, for example, like Taiwan, are actually in outright recession at the moment. So if you actually look at India, we are underweight pharma and software. We're also underweight telecoms. But what we like are these more domestically exposed sectors, so the consumer sectors, the broad industrial sectors, the private financial stocks. And that's where we think this low beta characteristic of India can really come to the fore, that these stocks can actually perform well, even when, let's say, the more globally exposed stocks in the global emerging market index are doing less well.
When you say that you're bullish on financials, walk us through the thought process. What makes you bullish on financials?
I think you've got to start with the key point, which is that India is underlevered. So if you look at the household sector and the corporate sector, the credit to GDP ratios are low. And they're low for a historical reason, which is that the government has historically run big budget deficits. Real interest rates have been quite high. And as the government runs smaller deficits and actually becomes more of an enabler of the private sector rather than a competitor with the private sector for capital, you can actually see the private sector itself leverage up, which is what we've seen going on in East Asia or in North Asia over the last 2 decades, to such an extent that we would now characterize North Asia, particularly China, as over-leveraged. But in India's case, that still lies ahead. So obviously we wouldn't want leverage to run out of control, but there is a virtuous cycle here where the corporates and the household sector, and particularly the household sector, have been under-leveraged historically. And those sectors can take on more leverage and also organically grow. And that benefits the financials, the private sector banks particularly.
So are you more bullish on retail banks rather than wholesale banks?
Yes, I mean, you want a bank that has a deposit base, has a simple business model, not reliant on wholesale funding. That's the kind of business model that works well, not just here in India, but there are other countries that have the same characteristics as India, like Philippines or Indonesia, where you've got this same underlying process of still low credit to GDP, ongoing, relatively rapid economic growth. In fact, if you look at Indonesia, Philippines, and India, they will grow faster than everywhere else in Asia this year. We're expecting India GDP growth of around 7.5% this year, accelerating towards 7.7 next year. And that really makes India the fastest growing major economy in the world, narrowly followed by Indonesia and Philippines.
Nifty is trading at about 14, 15 times, depending on the estimates you track. Do you think the scope for P expansion, at least in the medium term, is very limited? Now earnings have to catch up for stock prices to go higher?
Yeah, our story is more about earnings than the multiple. We're certainly worried about the multiple globally. If you look at the second Fed rate hike, which is upcoming at some point in the second half of the year, we think that's historically been somewhat negative for the multiple globally. But that multiple for India is now back in line with long-run average levels, whereas at the peak of optimism shortly after Mr. Modi took power, you had an India valuation that was a significant premium to global EM. So we think the valuation is okay.
You mentioned that you're bullish on consumers or the consumption theme. Now, Indian consumer stocks, either they're expensive or they're priced to perfection. If I look at staples, most of the staple stocks are trading at about 30, 40 times plus. Two-wheelers are not cheap, and four-wheeler names like Maruti are trading north of 30 times. So whereas this may be a great theme and this may be a long-term trend, but it's about buying the right stock at the right price. You may buy the right stock, but do you think the right price is not there?
It's certainly true that across the emerging markets in Asia, consumer staples are on high valuations to history. That is commonplace, in fact, globally right now, and people value the stability of the earning streams, and we'd obviously want to see dividend yield attached to that. If you look at consumer discretionary, I think what's interesting about some of these India names that you mentioned in sectors like motorcycles and autos is they're very high return on equity and return on net operating assets. So we run a framework called Best Business Models across almost 2,000 stocks that we look at in Asia, ex-Japan and emerging markets. And a number of Indian names do very well in terms of that high return on invested capital. And that, to our mind, justifies what at least optically look like somewhat high one-year forward Ps.
Do you think the most heartening sign for Indian equity market is that the retail investor or the average Indian saver is back? We are no longer dependent on foreign flows. I mean, they are still overweight India, but the return of the mutual fund industry and the SIP culture is something which could be the biggest differentiating factor for India?
Yes, that's obviously crucial to the long-run development of the market, as we've seen elsewhere in the world. And if we come back to the view that we have around a narrower fiscal deficit, better trade situation, the ability of the RBI to cut rates maybe 50 basis points through the remainder of the year, that all should help capital allocation move into the equity market.
Jonathan, let's talk about the industrials and the so-called cyclical sectors. It's a very wide basket. When we say industrial, it includes power, it includes cement, it includes just about everything. What are the spots you are picking up? I mean, what are your ideas for the long haul within the industrial and the cyclical basket?
I think the firms that are exposed to things like road construction, to ports and other infrastructure, far more so than, for example, steel, where unfortunately we think that China is still going to be a major feature in terms of exporting excess capacity. So I agree, you do have to pick your spots in those sectors. Yeah.
Every strategist has two types of ideas. One, tactical ideas, and B, structural ideas. So what are your tactical ideas and what are your structural ideas?
So I can't really talk individual stock names, but if you look at the sort of the long-run themes that we have, we've certainly said historically that the pharma and the software names, again, have very strong investment characteristics over the cycle. It's not the right time to own them at the moment because we're oriented to this domestic cyclical recovery. So I think both from a strategic perspective and from a near-term cyclicals perspective, we want to focus on those high ROE, RNOA companies, but more so at the moment in the domestic cyclicals and less so in the software and pharma names.
Historically, foreign firms have always avoided recommending PSU stocks and PSU banks in particular. Is there a reason why you should be changing your view there? Because most of the PSU managers, they've been very forthright. They've cleaned up their books. They're acknowledging that the worst of the print is behind them. If indeed Indian economy is on the threshold of a new credit cycle and economic cycle, I mean, these banks will do very well.
Yes, what you've seen actually is a high degree of transparency around that, probably higher than we see elsewhere in emerging markets, and that's to the credit of the authorities here. We have a relatively high NPL recognition, probably around about 4.5% last financial year, but we still have more that needs to be done, maybe about 3% of system assets for this year for those kinds of banks. The problem, I think, with those banks is that you need to sort of fully reorient them, and they do have very strong private sector competitors. And I think you need to break the nexus of links that exists between those kinds of banks and public sector corporates, which do, across the emerging world, tend to generate higher NPLs than lending to the broad, let's say, private economy. So yes, there'll certainly be individual stocks that we can look at, and it is to India's credit that it's sort of recognizing the NPL issue in its PSU banks. There are other countries in emerging markets that are not doing that in such a transparent way.
There are three global risks right now. First is Fed, then you got Brexit, and then the most debatable aspect, which is that who will be the next US president, whether it's going to be Democrats, whether it's going to be Republicans. That will change the dynamics. Walk us through these three events and what they could do to the equity markets.
Well, two of those three are political, and we tend not to like to talk too much about that. But what I would say, my colleagues who look at Brexit are putting the probability of that as slightly skewed towards Remain. So we tend to think that that is not a particularly big risk issue in the sense that the Remain vote will probably carry the day. In relation to the Fed, we have an interesting point that our colleague Ellen Zentner makes, which is that right now the dollar is doing some of the work of the Fed for it, in the sense that the dollar is strengthening significantly the last couple of weeks as people begin to talk about a June-July hike. Our view is that that actually in and of itself reduces the possibility of a June-July hike, so there's some kind of reflexivity there. We ultimately think that the Fed will end up delaying till December, till after that presidential election that you mentioned, and that that will be rather like last year when we spent a lot of time debating when the Fed would raise. Would it be March, June, September? In the end, they waited till December. So we think these two rate hikes will be a year apart.
So what is the biggest known risk and what is the biggest unknown risk for this market?
The biggest known risk, well, I guess if it was a known risk, it might be sort of fully discounted. The one that people ask me a lot about is in relation to the Fed, but also in relation to China, where we had a China summit from Morgan Stanley last week. It's about whether China's growth slowdown continues or whether the cyclical kind of recovery we saw at the start of the year is sustained. Our view on that is that China's economy is going to soften again in the second half. So in terms of sort of known risks other than the Fed, that's probably quite a big one. It matters more for other emerging markets, particularly in EMEA and Latin America, that export commodities into China than it matters for India. And it's partly because we have that view on China that we're looking for this kind of low beta characteristic that India has. In terms of unknown risks, I think what you probably mean is risk that the consensus doesn't evaluate as particularly high. I'd just make a quick comment on oil in that regard. I think the consensus view on oil has shifted dramatically from January, when people were very worried about what oil would do to, say, high-yield credit in the United States and to riskier sovereigns in the commodity exporting space. It is remarkable right now that with oil back at $50 on Brent, people are hardly focused on oil as a risk for the remainder of the year, whereas our view at Morgan Stanley is, again, that oil will soften through the remainder of the year, and so that might come back as a market risk factor.
Okay. Final question, pay attention here, Jonathan. If a client walks up to you right after this interview and he says, what do you like? Do you like Indian food more? Do you like Indian stocks more? Which way would you lean?
Well, at the moment, I always like Indian food, but we have just upgraded Indian stocks. I'd say we like both of them, yeah.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.